Hello, my name is Rajesh Menocha and I'm the founder of Financial Radiance. Welcome to my YouTube channel on personal finance. What I will be speaking about today is related to mutual funds. Mutual funds is a very vast topic, so let me start with the basics related to mutual fund. What is a mutual fund? This is an investment which is done with a pool of investors. So as an investor, if we want to buy a stock, we may not be able to achieve diversification there, or the stock itself may be very expensive. So what a mutual fund company does is that it pulls in money from different investors and then they invest it into those particular stocks. So it's a vast amount of money which is generated based on the scheme objective. So once they have collected the money based on that objective, then a fund manager allocates funds across different stocks, and he is also backed by a research analyst team who do the research and help him in terms of making the decision. Then after the trades are done, it depends on the investors whether they want to get back the money periodically by way of dividends or they want to put it in the growth option, and then they are able to generate returns over a period of time, and that's how the cycle continues. Most of the mutual funds are open-ended mutual funds, which means that investors can get into the fund or they can exit out of the fund at any point of time, and there is no limit or duration there for which they have to keep invested. There are a lot of advantages associated with investing in mutual funds. One is the professional management, because here you have a team of research analysts and the fund manager working, and mutual funds are governed heavily by SEBI and also through AMFI there. So that becomes one of the biggest advantages. Second advantage is related to the low cost, because they are able to average out the cost across the investors in terms of managing the fees. The funds charge fees known as the total expense ratio, which essentially takes care of the costs related to managing the fund. Another advantage is the scale of operations, because of the amount of money which the mutual funds manage. Diversification is another aspect, because then money can be invested across different stocks. A typical mutual fund may have about 60 to 80 stocks. Also, that diversification can be across sectors. Liquidity, I already spoke about, that you could exit the fund at any point of time whenever you need the money. Transparency, because the laws actually govern that the net asset value needs to be declared at the end of the day every day, and other than that, mutual funds are supposed to declare their fact sheets on a regular basis, and also the annual reports need to be published. Finally, another advantage is the tax efficiency. Mutual funds are tax efficient, especially over a longer period of more than 3 years for the debt funds and after 1 year for the equity funds. So now that we have understood about the advantages of investing in mutual funds, let me talk about one of the major changes which happened way back in October 2018. Before that, mutual funds were actually spread across different categories, and there was really no uniformity in terms of the definitions. We had funds which were classifying themselves as large cap, whereas a similar kind of fund was getting classified as a mid cap. At times the names were very confusing, which the investors were finding it very difficult to understand. So in October 2018, SEBI came up with a categorization wherein they categorized all the funds across 5 broad categories. In all, there are a total of 38 categories within these 5 broad categories. We may still say that the categories are a lot too many, but then I do feel it's a good beginning which has been made, and a lot of simplification has been done for the investors. So the first category is the equity schemes category, which has a total of 11 schemes in it. Now these can be varied depending on large cap, mid cap, small cap, or multi-cap, which is a mix of these, or it could be a large and mid-cap, value, contra, dividend yield, thematic, and a few more. So what SEBI essentially has done is that they have categorized that the top 100 companies by way of market capitalization can be called as large cap, 101 to 250 becomes mid cap, and anything beyond becomes small cap. And the list is published by AMFI every 6 months, and that's when the fund managers have to make the changes into their schemes to adapt to the new categories. So that way there is a lot of transparency. Beyond that, there has been a specified percentage in terms of how much can be invested across each categories. I'll just give an example here that minimum 85% is required to be invested in large caps for a large cap fund. Similarly, at least 85% needs to be invested when the fund is a mid cap fund or a small sector fund. That way, there are other categories specified as well. Second, we talk about the broad category of debt schemes. There are a total of 16 schemes under debt schemes. These are classified based on duration or interest rate or credit risks. Duration, it could be funds which are being invested for a very short period, like the overnight funds, or it could be liquid funds less than 3 months average maturity, or it could be ultra short with average maturity of 3 to 6 months, or it could be short duration, and then we've got medium duration, medium to long duration, long duration. So these are the different categories which are there under the duration set. Similarly, you could have funds which are taking risk exposure there, and then that also can be looked at. One example is the credit risk fund. Then there can be funds which can also look at the duration aspect there, and duration and interest combined. So there are funds associated like that, like the dynamic bond funds. So that's about the category related to the debt schemes. Then you have hybrid schemes wherein you have 7 funds under that, and these are the funds which are investing within the mixture of debt and equity. It could be aggressive hybrid wherein you've got more equity exposure, or it could be the conservative one wherein you have got more debt exposure, or it could be the dynamic asset allocation wherein the fund manager makes the changes between debt to equity or equity to debt depending on their views about the market. You also have other schemes like solution oriented schemes, which are essentially the retirement schemes and the children schemes. Finally, you have a category called other schemes wherein you have the index funds, you've got the ETFs, and you've got the fund of funds. Fund of funds essentially invests in different funds, and these could be international funds or these could be funds within India investing in other funds. So that really concludes about the basic discussion related to mutual funds. I hope it was of value. What I would like to do in this channel is to basically take one personal topic at a time every time and simplify the jargons. If you would like me to talk about any of the topics, then please let me know by providing the information below, or if you have any comments or any feedback, I'll be happy to receive those, and I will keep responding as and when it is feasible. So thanks very much for your time. If you do like my channel, then do subscribe to it. That's when you would get to know about all my future videos which I will be launching on a periodic basis. Thanks very much for your time. Until next time, thank you very much.